I had a look at the December bank participation report, and there are 5 US banks basically in that report. And if you look at their position in silver, they're net long of silver. Now we're talking derivatives, we're not talking about physical. The shortage, the bear position, is actually in the foreign banks, or what they call non-US banks, which tells us that, these banks, what they tend to do, and we need to understand this a little bit, what they tend to do is to run long positions in London and short positions on COMEX. So in a sense, it's not too surprising to see that foreign banks are actually short on COMEX. That's understandable. The problem we have to understand is that we're talking about derivatives. Now, the derivative market, in terms of its size, is many, many multiples of what is actually delivered. Further problem we have is that China is no longer suppressing the price of silver. It has given up doing that. It's been suppressing the price of silver for a long time. China is the second largest nation by mine output. Not only that, but she imports masses of silver doré and also other metallic ores, where silver, if you like, is refined out from that. So silver, in terms of global supply, silver is by far the largest entity when you take both mine output and also refinery output into account. From January, it's been announced by the Chinese authorities that they're tightening up on licensing for exports of silver. And what basically the principle behind it is to stop excessive amounts of silver going out of China. They're not stopping it totally, but it will be restricted. Now, this comes at a time when demand for silver is going off the charts, not just photovoltaic cells, not just India, which incidentally has been subsidizing photovoltaic cell production at the government level. So Reliance Industries, for example, one of the very, very big conglomerates, they're building huge, great solar farms, and they're in the business of manufacturing this stuff big time. So they're going into the markets to get the silver which they need for these photovoltaic cells. But the other thing which is driving it is electric vehicles, and the increase in range and so on and so forth comes really from greater use of silver in batteries. And Samsung have come up with a silver carbon battery, which gives you something like 900 miles, over 1,000 kilometers range. And it takes something like 10 to 15 minutes to charge. That's all. So this is something which is being introduced, I understand, for the more expensive luxury vehicles, EVs, in 2026, and will be spread out from there. Now, the problem is that if you just have 20% of EVs having these Samsung batteries, then that's the equivalent of total mine supply of about 25,000 tons a year of silver, because one of these batteries uses a kilogram of silver compared with the sort of conventional lithium batteries taking about 4 or 5 grams. So the demand for silver is going up very, very substantially. The reason that we've got this problem is that suddenly everybody in the industry, if you like, needs silver. They've got to go and buy it. So they're actually raiding the markets. They're going into London and buying forward contracts and standing for delivery. They've been doing this on COMEX more visibly. Stand for deliveries this year so far are about 15,000 tons. So COMEX is, we don't know the number in London quite so much, but COMEX is the largest silver mine in the world, effectively. It's the largest source of silver. So, by a long chalk. I mean, if you're looking, I worked it out, something like 58% of mine production is actually being stood for delivery on COMEX. This is just staggering. So it's not surprising that the price of silver is going through the roof. I mean, the other point worth making, Alex, is that we tend to look at these things as investors in regulated investments. Now, if the price of, let's say Microsoft or Nvidia or whatever goes up, then we know that it will rise to the point where sellers come in, because you've got buyers and sellers there the whole time. They're not all the same way. Okay, they like to ride a rising market, and more buyers will come in on the rising market. But at some stage, you will find that sellers will take profits, and so there will come in some supply. Price rises to the point where supply comes in. This is not happening with commodities, for the very simple reason that you don't have that depth, if you like, of investor interest. These are non-regulated investments. They're not in the investment pool at all. is purely industrial. So any hedging there is from industrial sources. So if you look at mines, for example, traditionally they've been the ones that hedge production because, they've got the bills to pay and all the rest of it. And if they get a price for silver, they don't want to find that the silver which they extract over the next quarter buys less than it does today. So they would hedge their production. What do they do now? I mean, they've got no interest in doing that. It doesn't make any sense. They see what's happening. They know that China has stopped supplying the West. They know that prices are going higher. So what do we do? Mine? No, I'm not going to hedge I'm just going to ride it. I mean, why not? And not only that.
When we go back and study monetary history, the great turning points never happen with polite announcements or gradual adjustments. They tend to explode out of nowhere. And in hindsight, everyone pretends it was obvious. What we are witnessing in silver today is precisely one of those moments. A massive structural break. A tearing of the global fabric that held the silver market together for decades. And I've said for some time that 2025 would be the year gold started front-running the breakdown of the dollar. Well, silver is now front-running the breakdown of the entire Western commodity pricing system. I sometimes joke that silver is the most misunderstood monetary metal in the world, but at the same time, it's the most indispensable industrial metal. And that dual role is exactly why we have a crisis today. People still imagine silver as a sleepy relic minted into coins by old men with beards. Meanwhile, Samsung, CATL, Tesla, BYD, First Solar, Reliance Industries, Taiwan Semiconductor, and half the AI supply chain are treating silver as an energy metal, not a monetary curiosity. And that is where the crisis begins. For years, the price was artificially depressed because there was always this ocean of above-ground bar inventories sitting on COMEX, LBMA, and Shanghai. But that supply is gone, not reduced, gone. And when something disappears in thin air, markets don't make polite adjustments. They snap. Let me start with the part nobody wants to admit. China has been suppressing the global price of silver for years, and I don't blame them. They are the world's largest refiner, a massive importer of silver doré, and they use more silver than any nation on earth. If you are the biggest buyer, of course you want low prices, just as America wants cheap oil. But something changed in late 2023 and early 2024. China stopped playing the game. They tightened export licensing on silver, and the announcements were buried in bureaucratic language. But the industry read it like a thunderclap. They understood exactly what it meant. China is keeping its silver for itself. And when the world's largest refiner keeps its silver at home, prices do not consolidate. They detonate. People ask me all the time, Alasdair, is this manipulation? And I always say the same thing. Silver is manipulated only in the way every strategic resource is manipulated. Nations act in their interest. Corporations act in their interest. Banks hedge in their interest. But they cannot manipulate physics. They cannot manipulate geology. And they definitely cannot manipulate the fact that global mine supply peaked in 2016 and has been declining ever since. The Silver Institute's own forecast shows record structural deficits for the next 5 years straight, deficits of 10% to 15% of global mine supply. And that is before factoring in the new class of silver carbon batteries Samsung is rolling out in 2026, which require nearly 1 kilogram of silver per battery compared to the 4 to 5 grams used in current lithium designs. People cannot wrap their minds around that. One battery consumes as much silver as 200 electric vehicles do today. And even if only 20% of EVs adopt that design, it consumes the entire annual mine supply. This is the part where the analysts think they should clear their throat and talk about substitution. But there is no real substitute. That's the joke. And it's not my joke. Iceberg Research said the same thing this year when they wrote, "Substitution in silver is a fantasy. Conductivity does not care what governments want." And if you want to see how absurd things have become, look at a tweet that went viral a few weeks ago. A trader posted a picture of a solar farm being expanded in India, captioned, "Every panel is eating the COMEX alive." And he's not wrong. India's solar initiative is being subsidized at the state level, and companies like Reliance Industries have been buying enormous quantities of physical silver to build integrated solar supply chains. When a nation of 1.4 billion people subsidizes energy and industrial build-out simultaneously, the metal doesn't go into ETFs. It disappears into factories, into panels, into wires, into batteries. It leaves the financial system entirely. This is exactly why I warned early in 2024 that the silver price would not break past the $28 to $30 suppression zone until the secondary inventories at the major futures exchanges had collapsed. Those inventories were the pressure valve protecting the Western pricing structure. They were the silver equivalent of the U.S. Strategic Petroleum Reserve, which the Biden administration drained to protect fuel prices. But unlike oil, which can be pumped, silver cannot simply be produced faster. You cannot command geology to obey monetary policy. And now those inventories at COMEX and LBMA have been drained to levels we have not seen in decades. And in Shanghai, they hit a 10-year low. The shell game is over. You can move silver from one vault to another, but you cannot create more of it by administrative decree. What people don't realize is that the entire structure of silver pricing was built on the assumption that these vaults would always have metal. Always. When industrial buyers wanted silver, they didn't need to knock on a miner's door. They bought long futures contracts, stood for delivery, and had the metal shipped out. This was the silver market's fatal flaw. It allowed industrial demand to deplete inventory without raising the price for miners. No price signal ever went upstream. The market could be drained without triggering the alarm. But when the vaults run out, the price must go vertical because the next marginal ounce has to be incentivized out of private hands. And private hands do not sell at COMEX prices. Now let's talk about the most explosive part of this entire situation, the banks. For years, investors saw the banks short positions on COMEX and assumed that the banks were driving the silver price lower on purpose. But the December bank participation report tells a very different story. U.S. banks are now net long silver. It is the foreign banks that hold the short exposure. And this is not as surprising as it sounds. Banks hedge long physical positions in London with short futures positions in New York. That's normal. It's how they neutralize risk. But the foreign banks, European and Asian institutions, are in the most dangerous position because they are short on COMEX while China has shut the valve on exportable silver. In other words, they are short a metal they cannot easily acquire. That is not a trading position. That is a bomb. And here is the irony. U.S. banks saw this coming. They have flipped long at exactly the moment foreign banks are trapped. This is why you are seeing enormous deliveries on COMEX. Roughly 15,000 tons so far this year. That is an astonishing number. To put it into perspective, COMEX is now the world's largest silver mine by output. It is supplying more silver than any nation on Earth. But COMEX is a fiction. It is not a mine. It does not produce anything. It is simply bleeding out its own reserves. And once something bleeds long enough, it dies.